We've been hearing you, Devina, for a number of years now. It was only befitting that you received one of the premier women, powerful women in business in India award recently as well. So thank you for taking the time out and speaking to us today. I want to start off, Devina, by asking you about whether you believe that there is an overhang of central banking policy for risk assets like equities in place currently.
Yeah, definitely. I mean, I think the last year or two, this whole talk of inflation, interest rates, so what are central bankers thinking? It came out of chatter of economists alone to now all the market participants and stock market chat rooms also, I bet, discussing this. So yes, I mean that does remain, and in some ways it has been a lesson to the market on what you usually only read in finance textbooks. Cost of capital is important, that when cost of capital changes, the discounted cash flow value of any business changes, and therefore the stock price changes, and therefore the fact that interest rates are a key determinant of, even if you look at it from the PE lens. So I always say that to determine the PE you need to know three things. None of them are very easy to know, but the growth rate, the return on incremental capital, and the cost of capital. So this directly impacts the cost of capital. But I mean, things are never quite so easy. The market never makes it easy for you. So it's not as if now interest rates are going to go up, that necessarily means that it is bad for the markets, because it also, you have to take into account how much of it is already in the price, how much of it is already discounted. So that you have to take into account. But yes, I mean, everybody will continue to watch the central banks and what they do.
So an obvious question that might come in, Devina, since you brought up how much is in the price, that if a state of continuous US rates uptick pressure evoke a larger correction in emerging market assets, or would global growth coming back from the lows of 2022 for a bunch of economies and areas commensurate for that pain? What is your sense?
See, actually, if you look at many of the emerging markets, they were very proactive in raising rates. So this is something I had said in 2021, and that while US and India have not changed their rates, many emerging markets from Russia to Brazil had by that time hiked rates not just once, but 3, 4, 5, even 6 times. So so the dynamics are somewhat different. And in fact, right now the emerging markets are looking better than the US. So also is Europe too. If you're looking in a medium term, not on a 1-2 month basis. I mean, we're just watching to see whether that's like kind of a multi-year trend change, or whether that's more short term. Within emerging markets like Brazil, Mexico are looking good. Taiwan, of course, which is like in this thing, is also looking good. So but in general, emerging markets are not looking bad at all after a very long period of underperformance. The last great bull run in emerging markets on a relative basis was 2003 to 2007. So that's a space that we are watching carefully, and we think maybe leadership may pass that there along with Europe. So for example, I was talking of a disconnect between fundamentals and markets, and Europe is a great example. Last quarter of 2022 onwards, in fact, we missed that move because we were too focused on all that could go wrong with the economies, but the markets just took off ahead of that. So as I said, markets don't make it easy for you.
Interesting. I was reading a BlackRock note of yesterday, which seemed to suggest that Europe relatively looks much better than what US equities would be currently appearing to be. You echo that?
Yeah, I just said that. I said
yeah,
that
that's
Europe
what I'm saying. So relative to US as well.
We continue. I mean, right now, what is looking the best along with the emerging market economies I mentioned is several markets in Europe, UK, France, Germany, all looking good.
Got it. Now, just since I heard you say that there is a possibility, there's always a possibility that EMs might take some bit of a leadership as well in an up move. When I look at ASEAN strategy notes, Devina, they all seem to be constructive on a few other Asian markets and underweight India. When I look at the recent Indian strategy notes, they seem to be talking about this fairly prolonged period of flatline performance for India and relative underperformance for India as well, and make a case that maybe there is a time or a case for a bounce back from India as well. How is it
Yes.
that you are reading this?
So India, we do not think that there is a huge downside risk at these levels. It might tread water for a little more time, but uh, over the medium term, like a 1 year basis, we still think the outperformance trend isn't broken. It will continue. And yes, of course, there are many challenges in terms of the economy, even in terms of some areas of corporate earnings. But we continue to be relatively also positive on India, except not for the very short term. I would say that, very short term, it's not looking that it will greatly outperform the globe, but the downside certainly appears limited.
Why so?
Well, I mean, for one thing, if you look at just how the market has given returns over a period of time, I think spoken about it earlier. We were far below the trend line because while we talk of this 15-16% compounding that you get from the Indian equity markets, the decade to decade changes or differences are very great. So the first decade from when Sensex started, which was the 80s, you got 21% return. The next decade, you got 14%, even though it was all budged towards the beginning of the decade, and then 17%. And then 2010 to 20, you got only 8 and odd percent. And remember that time, FD rates were about 8%. So you hardly got any equity returns. So when that big move started from 2020, I knew that it will not stop in a hurry. So because you're still so far below the trend line, and which is why the risk also is limited, because the risk really of a big crash comes when you're far above the trend line. So we're not there yet. Of course, as I said, that there are many. If you look at the economy, there are many things that are hurting. If you look at the organized sector and the corporate sector, the picture is somewhat better, because in India you have this situation where the citizens as a whole are hurting, because that shows that 60% of people require free food. You look at the two-wheeler numbers, while they are up now from the lows till last year, they were at a 10-year low in terms of volume. So all that shows that what's happening. Even if I was looking at some data on real estate, I have still to see the whole report, but basically that there's nothing happening on affordable housing, and only that high-end luxury
Yeah.
uh, uh, homes are doing well. Cars, same story. Luxury cars, SUVs are doing well. As I had tweeted also a while back, that just saying that hotels, five-star hotels are full, or luxury cars are doing well, that people like us are not the whole economy. You must understand that, and that came through now in the GDP numbers also. I mean, what really disappoints me is that on manufacturing, we are just not taking off. For last quarter also, we had a negative number on manufacturing. Even 9 months year to date, we are just barely in positive territory. I think plus 0.4% or something, in spite of a bad base. So, and on employment, hence, because unless you get some mass manufacturing, also hard to get the employment numbers going. So those are the challenges. If you talk of demographic dividend, again, demographic dividend, people think is simply having young people, more people in the working age population, but that's only the first factor in the equation. So the second factor has to be how many people out of those are employed, and the third
Yeah.
factor is the productivity, and we are just not there on the other two factors. Unemployment is worse for the young than, even as a whole also we're not doing well, but for the young it's even worse. So those are challenges, but this skewed growth also means that the organized sector, which is the corporate sector, is in a relatively better position, but you are seeing pressure on earnings in many cases there too. So we are not very, very positive on the overall that consumption story. So, for example, we don't particularly like durables or paints and some of those segments.
Got it. Devina, in which case, I'm just trying to understand what drives this optimism. I can understand mean reversion if there is either earnings growth or a valuation uptake. Now, valuation uptake can't happen because India doesn't trade cheap per se, relatively. So, and you're talking about currently the earnings picture not necessarily looking the strongest. So, is it a belief that medium term organized India shows earning growth irrespective of what happens to GDP and therefore markets follow that?
So medium term that is there, but see, as I always say, it's not very hard to draw a one-to-one correlation, because if you look at China, for instance, last year it was half of 2007 levels, even though Chinese GDP had gone up 6.5 times since then. So it can be that kind of disconnect. And I was looking at P's. It's not as if that we are way out on P's relative to our own history, though, as you rightly said, that in India never trades cheap, which is why you will never find a dividend deal story in India, because anything which pays reasonable dividend, then it is all in the price and more. So that is true. And see, unlike uh, and this has been true not just now, but for last year and a half, that it has been a sectoral and company wise market. Only 2021 was the time when almost everything went up, barring the banks. But other than that, it has been a pick and choose market. So that really continues. So we continue to look at things sectorally. We continue to look at things bottom up. For instance, for the last year and a half, our biggest overweight sector has been industrials and capital goods, and that continues to do well. Banks, after being like kind of zero weight almost, at least relative to the market, from 2020 till the middle of 2022, we went to market weight with price movements. It's become somewhat overweight. So there, I mean, you can make a fundamental case also that NPS cycle is behind you. The credit growth has been reasonably good, and interest rates going up, at least in the beginning, help banks by the margins going up, because your assets get repriced quicker than your liabilities do, which is the deposits do. So those, I mean, you can, and besides that, it has been mostly bottom up. IT, we are more positive now. So we have gone somewhat overweight IT. IT again is like reasonable predictability, reasonable, the dollar also helps. So of course, last year, first half, that was an underperformer, but we think that period is now over. So those are some of the things that we like. Auto components of late we've begun to like a little more. So we've added some in auto components, a few selected pharma names we've added. So it has to be little sectoral, little bottom up. But as I said, the risk of a big crash doesn't appear imminent.
But that is because selectively in some of these heavyweight sectors, earnings growth might be strong and your portfolios might be positioned for that, which is why you believe there won't be a large crash as well.
Yeah.
Okay, great. Couple of questions. So if indeed rates globally stay high, Devina, how do you foresee rates within the Indian landscape, and thereby what happens to rate sensitives? Because the whole call of moving to NBFCs and exiting banks because there'll be a rate cut come March, or peak rates in March, has gone out of the window from an Indian perspective too, I presume. So how do you look at rate sensitives in wake of what's happening in the West?
Okay, I mean, so just to tell you what's happening in our portfolio, I don't think we have any NBFCs at all. We do not have real estate also. So those are not sectors that we particularly like. Okay. And lenders, I am always super careful. So because in lending, you don't know where the negative surprises will hit. And every decade, I think having a long memory sometimes is a negative. You remember some kind of NBFC.
But you anyways believe in data.
Right. So I mean, whether it was leasing companies one time, or some other type of companies, some other kind of lending business, and then it became fintech. And see, the thing in lending businesses is that people will say that we are running ahead of targets, and I always laugh, because it's how difficult is it to lend out more and more. So I'm a little skeptical, and as there's a quote, I forget who said that almost all innovations in finance come down to increasing leverage.
Ah,
So,
and risk.
so they are all different forms of just increasing leverage. So I mean, be careful, and even banks. While I said that we are now market weight, I mean that's a sector that I am always wary of, because in any lending business, the negative surprises come out of the blue, and as an outsider, you can never know where those negative surprises are hiding. There is no way of knowing that. So even a famous call of HDFC Bank in 1 year out of IPO in 1996. I always say that, like for Amazon, also we were an outlier, and but in Amazon it was pure numbers and data. I always say in HDFC Bank it was not purely that. I mean, obviously there was a case to be made about market share moving to private sector, etc., etc. But there I knew the people, and I was also taking a bet on the people. So banking is a tricky business, and NBFCs are like one step even riskier than that.
Where
So,
are you
but
an out?
coming back
Sorry.
to the rate question, yes, I did not answer that. Uh, it's a tricky position for the RBI, because we have a growth issue, we have an unemployment issue, which is not there so much for the Fed. I mean, the growth might be there, but the labor market is very strong there.
Yeah.
Here we have very high unemployment, we have a huge amount of distress in the economy, and we cannot afford for the growth to slow down. So it will be tricky, but I don't see the rate cuts coming anywhere in the near future, for either in India or in the US for that matter. But how much to hike, that will be a tricky road for RBI.
But effectively, that also rules out some of these rate sensitivities, even for people who might be bullish that you are not. But even if people are, just stay out of the game, because rates are probably, as you said, not coming back down in a hurry. I would love to ask you, sorry, two more questions before I ask you the final question of advice for women investors, Devina. Lovely to end the show with today, apt as well. Question number one, on I heard you speak about pharmaceuticals. Now, in the last 1 month, I've heard some fairly experienced pharma specialists talk about how valuations compel them to look at this space, even if there is no near-term uptick in sight. So they are talking about spacing out their buying, but they believe that valuations eventually will hold the downside and eventually give them upsides. Why is it that you are nibbling at pharma?
Our systems like them. So I mean, that's, see, for us the first filter is always our artificial intelligence machine learning system. So I mean, what goes behind that obviously is all the financials of the sector. So we see now more pharma names coming up, just as we saw a lot of industrials and capital goods coming up, and they still come up in all our systems, because we relook at everything from a zero base every quarter. So if we
Every
had
quarter.
cash today, where would we be? So we see more pharma names coming up. So that is one. And so especially the players that are reasonably good on the domestic side, I find that we skew towards that. And we do have a lot of experience in-house on the fundamental side of pharma also, to drill down and see what everybody's product lines are, and how they are doing. So we picked a few. I mean, it's not a hugely, it's not a very high weighted sector, but relative to the index, we would be somewhat overweight now.
And
We
overweight,
anyway don't take very outsized bets. We are fairly diversified.
yeah, but domestic as well, overweight Indian generics, or diagnostics and hospitals, or API CDMOs. What bucket, if you will?
And not so much the diagnostics and hospitals. I'm talking the pharma place.
Pure pharma. Okay.
Yeah.
Okay. So is that the pocket where you are the outlier? If you had an HDFC Bank in the 90s, Amazon's in the 2000s, what is the outlier bet on a Women's Day special? Can you talk about that?
So as I said, our way out, sort of overweight has been since October 21 in industrials and capital goods, and that has been a hugely good performer. So now, and some of the stocks went up twice or thrice also, and we have booked some profits, but even so, it would still be relative to the index quite a bit overweight still. And still we see that in fact, our systems throw up so many names that we have to eliminate some of them. but that sector still remains the most overweight. And we can, and again, see, it had come out of, I think since 2008-9, it had been a dog sector, absolute dog sector. I think it compounded only 2% for that 12, 13 years. And so it came out of that long period of underperformance. And because the companies hurt so much during that time, they had also cut costs, improved product lines. So when that uptick came, they were all ready, and it showed up in the profit. So that's been a great sector. So that would still remain overweight. Though, as I said, we have booked some profits, cut it a bit, but still.
Okay. One final question, Devina. And everybody has a different thought to this. Some people say the investing advice need not be different for a male investor versus a female investor. And some people say, well, it could be, because a lot of women are homemakers. Some of the women are working and don't have time from a markets perspective as well. Very few are probably professionally engaged in equities full time, whether the mutual funds or in some other route or direct equity. So my question to you is, I'll have to average it out because I can't ask individually, but one key advice for women investors from your end.
Okay, I mean, this is a cause for me, so I can talk for quite a while in this. But I mean, my one advice would be, first of all, that take charge of the finances, because I find too many women, including professionals and senior professionals, that leaving the money management part to the men in their lives, the fathers, the fiancés, the husbands, or whatever, saying that he understands it better, or I don't have the time. So delegate other stuff, but make the time for this. So this is number one. Number two is that competence is not the same as confidence. So confidence does not equal competence. Write it in gold letters in front of you. So just because you're the man in your life acts as if they know more about investment does not necessarily even mean that they know about it. And data shows that when women do investing, their performance is better than the men, but their confidence levels are lower. So forget about all that. Do this, and also don't be at either end of the risk spectrum. Last year I saw people, including women, moving from fixed deposit to crypto and option trading. That's a recipe for disaster. So have a balance. And the good part, since I mean everybody talks about time, is that asset allocation determines 80 to 90% of your returns. So if you get that right, you don't have to be looking for the next multi-bagger. So have within India portfolio, diversified portfolio, 25-30 stock. Include global investing in your portfolio, in your asset allocation. Do not have everything in equity, but do have significant portions in equity. So those are the things. And as far as the women don't have the time, the reason they don't have the time is that the all the home, even if they're working outside, the home physical and emotional labor is on their head, and they say that, fine, the husband is willing to do this thing, so let me take this off my plate. And that's the wrong thing to do. So unless you have control over your money, unless you have financial independence, there is no way you can be independent.